One quarter of men aged 18 to 29 say they trade stocks every single day, yet nearly two-thirds report feeling like failures. This statistic from Bloomberg reveals a painful contradiction that millions face but few understand. You might assume this failure stems from a lack of intelligence or work ethic, but the truth is far more structural and mathematical. The feeling of being a failure is not proof that you are broken. It is the correct emotional response when playing a high-variance game against professional algorithms with no structural edge. Today we connect this headline to the household decisions you control by understanding why daily trading is designed for you to lose, regardless of your skill level. When we look at the mechanics of financial markets, we must first distinguish between games of pure skill and games dominated by variance. If you play chess against a human opponent, effort correlates directly with outcome. The more time you study openings and practice tactics, the better you become. However, individual stock trading is not a game of chess. It is closer to playing poker in a casino where the house has already rigged the deck. Academic research into retail trader performance consistently shows that daily traders operate at a distinct disadvantage due to transaction costs and fees. While the market appears neutral on any single trade between buyer and seller, it is actually a negative-sum gain for active participants once commissions, spreads, and taxes are factored out. This means you do not need to be wrong about which direction prices move. You simply need to trade frequently enough that the house edge eats away at your capital over time. Quick resource note: I keep a curated set of Amazon search links in the description for books, gear, and tools relevant to this channel's topics. Some are affiliate links, so I may earn a commission at no extra cost to you. Please consider supporting the channel by using those links if you find something useful. The structural disadvantage becomes even more stark when we consider who is on the other side of your screen. Professional markets are dominated by high-frequency trading algorithms that execute trades in microseconds based on complex models no retail trader can replicate or access. Imagine trying to beat a supercomputer at speed dating while you have 20 seconds per move and they process millions of options simultaneously. This is not a failure of human skill, but a fundamental mismatch of technology and speed. When you attempt to compete daily against these systems without their infrastructure, your effort does not translate into an advantage. You are effectively playing a game where the odds shift in real time based on data streams you cannot see or process fast enough. The feeling that something is wrong with your approach is actually evidence that you are fighting the mechanics of the market itself rather than learning from them. This environment creates a specific psychological trap known as the psychology of variance. High-frequency trading introduces extreme volatility in outcomes over short timeframes, making success feel random and unpredictable to the human brain. Research indicates that when effort does not correlate with outcome due to external noise, our brains default to internalizing failure rather than attributing it to system mechanics. We blame ourselves for losing money because we assume there must be a skill gap if we are working hard but seeing poor results. This creates a toxic feedback loop where increased trading frequency leads to higher emotional distress regardless of actual market conditions. The more you trade, the more variance you expose yourself to, and the less likely your effort is to produce a consistent positive result. The data on this failure rate is not an anomaly. It is the baseline for daily trading without professional infrastructure. While specific recent study access was blocked by security protocols in some searches, established literature confirms that a vast majority of active traders underperform passive benchmarks over time due to behavioral biases and structural costs. We are talking about figures where 95% of day traders lose money or fail to beat the market average within their first year. This is not because these individuals lack intelligence, it is because they are engaging in a high-variance contest against professional algorithms with no speed advantage. When you trade daily, you must be right and lucky just to break even after costs. The feeling of failure isn't proof that you aren't smart enough. It's evidence that the game mechanics involving fees, spreads, and randomness are designed to make consistent daily profits statistically improbable for individuals. Recognizing this reality offers immediate relief from shame by reframing your experience as a rational response to an unfair system rather than a personal deficit. When effort does not correlate with outcome because of market noise, our brains blame ourselves. The data suggests we should be blaming the system instead. This shift in perspective is crucial for financial stability and mental well-being. It validates that walking away from daily trading isn't giving up. It's a rational decision made by anyone who understands the game mechanics. By stepping back, you stop fighting a battle where the house always wins through speed and cost advantages, allowing your mind to recover from the constant stress of trying to outmaneuver an algorithmic opponent. The exit strategy involves shifting focus from daily speculation to long-term ownership, which changes the psychological outcome entirely. Long-term investing relies on structural advantages like compound growth and market participation over years rather than minutes. This approach aligns your effort with a higher probability of success because you are no longer competing against high-frequency algorithms for micro-movements in price. You become an owner of productive assets that grow over time, removing the noise that triggers self-blame. In a negative-sum game like active day trading, you don't need to lose money. You just need to trade enough times that costs and variance eventually catch up to you. By choosing not to play this specific high-variance game, you reclaim control over your financial future without needing to outsmart the machines or win against impossible odds. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.